Hello, everyone. This is Team 7. My name is Alexey Katunin. Our team examines Paul Tudor Jones' transformation of behavioral psychology into systematic trading age during hedge funds' pivotal evolution in 1987 to 1992. We believe that Jones revolutionized finance by turning market irrationality into profit engines, shifting the industry from fundamental analysis to behavioral engineering. I opened the presentation thus deconstructing Jones' theatrical use of cycle theories as psychological tools. Nick Luxman contrasts his script technique, mental simulations of market chaos with Julian Robertson fundamental stock picking. Peter Kiev analyzes price execution, how Jones engineered asymmetric bets during the 1987 crash and Japan's 1990s collapse by exploiting institutional mandates. Jeff Fourier covers his cut and pick origins, revealing how floor trading shaped his style. And finally, Tom Chamberlain demonstrates how Jones pioneered avalanche triggering tactics that exploited Schleifer limits of arbitrage decades before academic formalization. All evidence draws from Malaby's More Money Than God and trading records. Jones' promotion of cycle theories reveals deliberate narrative engineering. He publicly cited Kondratyev's 24-year race to justify his 1987 crash prediction, despite the model's next official trough being due in 1997, a decade-long discrepancy. Similarly, his endorsement of Robert Prescher's Elliott-Wave analysis invoked apocalyptic 1720 subsea bubble parallels that miss both timing and magnitude. Crucially, economist Peter Borish admitted to fudging data overlaps between 1920s and 1980s charts, adjusting start dates to force visual correlations. This pseudoscientific theater served dual purposes: intimidating competitors through manufactured crystal ball credibility and distracting from his mathematical edge. Now I give the floor to Nick, who will talk about the difference between Jones' approach and that of old school investors.
Thank you for that great introduction, Alexei, and for covering Jones's interest in cycle and wave theories. I'm now going to get into how Jones' investment style differed from Robertson's and describe the unique script techniques he employed. Julian Robertson was the founder of Tiger Management, and he was best known for his fundamentally driven approach to making investment decisions. He tended to focus on in-depth research and analysis to identify mispriced assets and would take long-term positions that bet on those assets to move in the direction that he predicted. His strategy demanded a deep, fundamental understanding of the assets and did not heavily rely on market timing. In contrast, Paul Tudor Jones was known for his macro approach to trading. Instead of focusing on individual companies, Jones focused on broad economic trends and market cycles around the world. He tended to rely heavily on technical analysis to identify shifts in momentum and to accurately time his trades. Jones was adept at interpreting market sentiment and was comfortable with quickly repositioning his portfolio as conditions changed. Jones preferred flexibility and agility to long-term holdings. A unique component of Jones's trading method was his script technique. Jones would come up with a detailed plan in his mind in which he would map out possible market scenarios and determine his planned response to each of those scenarios. By doing this, Jones was able to help mitigate any irrational response to changing market conditions because he had already mentally worked through what he thought he was going to do. By going through this exercise, Jones created a clear framework that guided his decision-making, even while under significant pressure, and allowed him to be prepared when the markets took an aggressive turn. I'll now pass it over to Peter, who will get into some of those times when those markets did take some more aggressive turns.
And now we will talk about how Jones handled the 1987 stock market crash in Japan. And talking about it, we should admit he managed it in a magnificent way and illustrates his psychological approach to trading and his ability to write scripts for market behavior. By doing diligently his homework before the stock market crash, on that night, Friday night evening, Jones had already sold significant quantities of his S&P 500 futures, positioning himself to profit from the coming disaster. On Black Monday, Jones demonstrated his superior market positioning and managed to stay cool while other investors panicked. Profiting from both the stock market crash and the bond rally, he proved that his approach was really a masterclass, which reportedly netted his investment corporation between 80 and 100 millions, contributing to his 200% return for that year. For such a masterpiece performance, Jones understood very well the specific market situation and refused to short the market prematurely, even as the Nikkei gained an astonishing 63% over 2 years. The key to John's success in Japan lays in his institutional understanding of market mechanics. When Tokyo fell nearly 4% in early January 1990s, Jones recognized this is the signal that he has been waiting for a long time. Jones' predictions proved remarkably accurate, with the Nikkei falling 7% in February, 13% in March, and losing almost 2/5 of its value by the end of the year. When Nikkei stabilized in spring, he switched from a heavy short position to a moderate long position, profiting from an 8% stock rally in May, even though he remained convinced it was temporary. Next, we will talk about the role of timing and investor positioning in Jones' trading style. And timing and understanding other investor positionings were the solid base of Jones' trading philosophy, rooted in his experience on the cotton exchange floor, where he learned that the key drivers of prices in the commodity pits were not the economic data, but the wild guy screaming in his face. Jones understood that successful trading requires not just analyzing own market position, but also sensing what other traders were doing, whether they felt greedy or afraid, whether they were poised to go all in or were dangerously extended. Jones's focus on institutional positioning helped him identify situations where he could profit from forced transactions and predictable behaviors and patterns. These institutional mispresentations allowed Jones to buy and sell in situations where he knew he was getting a good price because the person on the other side of the trade was forced to sell. Perhaps most distinctively, Jones understood how his own trading could change other market participants' calculations and behavior, and setting off profitable change reactions. Unlike most upstart traders who try to conceal their positions through multiple brokers, Jones recognized that sometimes it could pay to be as loud as possible. Jones' ability to trigger market movements was a masterpiece and was precisely demonstrated in his oil and silver trades, where he first built positions quietly, then switched to his wild cowboy style to scare other traders. I would like to thank all of you for your attention, and from this point, Jeff will continue with our team presentation.
Paul Tudor Jones grew up in Memphis, Tennessee. His family there had deep ties going back generations in the cotton industry. Memphis has always been kind of one of the commercial seats of that business. After graduating from UVA, he took a job in New Orleans with Eli Tullis, who was a legendary cotton trader down there. And Jones worked for him, sort of answering phones, uh, taking down information from the Cotton Exchange in New York. But after a night of partying in New Orleans, Jones was fired by Tullis. He fell asleep at his desk. This led to Jones leaving New Orleans and Memphis behind and going to New York to take a job at the Cotton Exchange there. Uh, and this was 1983. So he went there. He was working in the cotton pit, and that was in New York where he founded Tudor Investment. Um, at the exchange, what he found was uh, the sort of efficient market hypothesis style, economic market that he probably learned about as an economics major at UVA was not what he saw on the floor of the cotton exchange. He did not see fully informed actors making rational decisions. He saw a lot of emotion and a lot of sort of I think vibes, and really he sort of developed part of his way you know, um, of investing based on behavioral and how do you it's not even the new information, it's how do you think people will react to that new information, how will the actors in the market react to it. And he basically, developed the ability to treat trading like a game, like a poker game, and like an exercise in group psychology. And that was part of what helped him see the 87 crash coming. I think even more so than some of the modeling that the historical modeling that some of his business partners had that predicted a crash was coming, but had it later. I think his understanding of psychology that he picked up in the cotton pits helped him a lot there.
Paul Tudor Jones exploited the limits of arbitrage using market psychology and timing to profit where pure logic said there shouldn't be profits. In Malaby's chapter on the rock and roll cowboy, we learned that arbitrage isn't always as clean as textbooks suggest. For example, according to the prevailing theory, if two assets are mispriced relative to each other, arbitrageurs are supposed to jump in, correct the prices, and eliminate the opportunity. But in the real world, especially in big liquid markets, that's not always how it works. Jones understood that even when an asset seemed mispriced, say a currency or a stock index, it could stay that way longer than rational traders could hold their positions. Other investors might be constrained by risk limits, redemptions, or just fear of looking wrong in the short term. That's the limit of arbitrage. Prices don't snap back instantly just because they're theoretically out of line. Jones would watch for these moments, using his script technique, his cycle theories, and step in precisely when others were forced out. During the 1987 crash, for example, he didn't just short the market early, he understood when panic selling would create temporary mispricings. He was disciplined enough to step in when others froze. In short, Jones didn't rely on arbitrage in the classic sense. He exploited its limits by reading the market's mood, knowing when others couldn't act, and using that window to make bold, well-timed bets. In conclusion, forgive the cowboy metaphor, Paul Tudor Jones wasn't the kind of cowboy riding fences. He was the one waiting at the edge of a stampede, knowing exactly when to swing back into the saddle to bird dog the parts of the market he wanted to get back in line. Where others got trampled trying to play it safe, he thrived in the chaos. That's how you ride the markets like a rock and roll cowboy. Timing, nerve, and knowing just when to hold on tight and when to let go. Thank you for watching.